So we can see Walmart's revenue has been constantly going up throughout the years, but net income has been decreasing every year. We'll take a look at why in today's episode of Buy or Pass. Hey guys, my name's Jose, and this is another episode of Buy or Pass. In this series, I will look at the financial documents of a company and decide if I was looking for another investment. Would I buy or would I pass? Before we start, don't forget to hit that subscribe button to get info on new episodes and other videos. So let's begin. This is going to be the second part of the last episode I did. Last time we took a look at Walmart's earnings presentation for Q4, which also helped us look at the annual data. Today we're going to take a look at my favorite website, lazyfa.com, which allows me to see all the financial numbers in the past quarter and years in an easy visual format. So we'll take a look at them and then decide if I would buy or pass on Walmart. Alright guys, here we're on LazyFA, taking a look at Walmart's information. Right now we're going to take a look at the income statement. We can see right off the bat we've had an increasable revenue each year. Fortunately, with that, we've also seen an increase in cost of revenue. But the great thing is our gross profit is increasing, so that means our revenue is increasing, is much higher than our cost of revenue. So if we take a look here, one of the things that kind of threw me off, where I had to do a little more research, net income kept dropping over the past quarter, even though over the past years, even though revenue itself seems to be increasing little by little. The amount of revenue that's been increasing has not been by much. It's been like, for most of the time, a few $billion. 15, 16, 17, it was pretty much flat. But wondering was, even though it was flat, why this net income kept dropping. Well, in 2019, it hit pretty low, and I decided to take a look instead at the quarterly information. The quarterly information showed me something pretty crazy. It showed me in quarter 2 of this past year, Walmart reported a net income of negative $861 million. So that alone would make this so much higher. And I wanted to see why we had that negative income, where normally it will be around $2 billion. So in reality, there was a delta change of about $3 billion, right? The negative $861 million plus the $2 billion it averaged. So if that was in charge, this would be around the levels of 18. So I ended up doing a little bit of research, and I was taking a look at past news data. And here we can see that the main reason was there was a one-time such loss related to the sale of majority stake of Walmart in Brazil. This happened in quarter 2. So in quarter 2, Walmart sells majority of Brazil unit and takes a $4.5 billion charge. $4.5 billion is pretty high, so I wouldn't even put the whole $4.5 billion, but let's say we would increase this by up to $2 billion, like I mentioned. Our net income would be higher than last year's. So that's good news, right? It was definitely a one-time charge, and it's not something we're gonna see again. But besides that, everything else looks good, right? We have that healthy revenue. Cost of revenue has not increased as much, giving us that positive gross profit. Now let's take a look here at red flags, if LazyFA is gonna throw us any red flags. Right here, just we start off, right, we can see that difference between revenue versus cost of revenue. We can see that gap there, and that gap right there is going to give us our gross profit. Our gross profit has been increasing over time. One thing here, this is revenue versus cost of revenue's growth percentage wise. It seems to always be almost a 1-to-1 ratio. Cost of revenue increase at a higher pace, but it's not that much higher. So it's almost a 1-to-1 ratio at the moment. So everything still looks pretty normal in that regards. One thing here though is this year they did have a lower profit margins, but that's because that net income this year was a lot lower for quarter 2, especially due to quarter 2. So it reduced this profit margin. But profit margin for this company actually really low, right? It has about a 3.5% profit margin. And finally, we have some red flags throwing up here. The first flag is just telling us that cost of growth, revenue growth is revenue growth is growing at a slower pace than cost of revenue. Like we've mentioned before, right? It's almost a 1-to-1 ratio, so that's not a red flag that I really want to take a look at. The next flag is just telling us that net income has been decreasing dramatically over the past 2 years. So I understand why we had such negative net income growth this past year, but I can't tell you about previous years. So unfortunately, that's kind of definitely throwing me a red flag at the moment. But we do know that Walmart is purchasing and increasing its e-commerce type data from the last report we did. Next, we'll take a look at the balance sheet. So in the balance sheet here, we can see total assets increasing, unfortunately total liabilities and total debt increasing. Our total debt is right now at $58 billion compared to last year at 46. We can see a majority of this liability growth is due to the total debt, right? Total debt increased by about $12 billion, and our total liabilities grew by about $15 billion. So a huge percent of it was due to total debt. Receivables is increasing, but payables is also. They do have a strong payable liability. So payables is just what they're paying their suppliers and their vendors. And we can see it's actually $47 billion. It's almost 1/3 of its total liabilities. And we'll probably see that in the total asset and liability distribution. This company has some nice amount of cash and cash equivalents, which is pretty good, sitting at $8 billion. Still not enough to make a dent of its total debt. Let's take a look right at the red flags. We can take a look here. Fortunately, our shareholder equity has been decreasing. That's because our total assets and liabilities are close. Our debt gap is getting smaller. Here we can see, right, we've had liabilities growth increasing at a faster rate than assets, but assets are still growing. It is pretty crazy to see our shareholder equity dropping. It's again not a thing I like to see. Here we can see payables and total liabilities. At the moment, payables is actually 40% of total liability, followed by another 40% is on non-current debt. Next, current debt, there's a huge amount, not a huge amount, almost $8 billion of current debt. But we can see this company, does not seem like it's paying off much of its total debt at the moment, right? We can see here from graphs, there's moments where it's decreasing. It's pretty much been around this area. So it maintains this steady liabilities in both non-current debt and payables. Payables does seem to be increasing over time. Here we can see total assets. The main total assets are property, plants, and equipment, sitting at 56. Now, obviously, this is a big retail chain. They definitely have a lot of stores, so a lot of equipment and plants are definitely, and properties are going to take a huge portion of that asset allocation, right? There's so many Walmarts, and that real estate itself is an asset. The next big portion is inventory. Like I mentioned, this is only a supermarket, so it makes sense that inventory is their next biggest asset. But what I want to make sure inventory has been pretty flat, right? I do like to see inventory either flat or decreasing. My main reason for wanting to see that, right, is if I see inventory increasing too much, it means they're buying stuff, they're not selling enough. If I see it flat enough, is they've maintained this nice pace where they're selling and buying at an equal rate. Obviously, I would prefer to see decreasing, but at the moment, being flat is not a horrible thing. Last thing we're going to take a look at is cash flow statement. We can see this company has positive cash flow from operations. That's the only cash flow from I care about. cash flow from operations because that means it's making money out of its everyday use. Unfortunately, it is pretty flat. So we talked about the last presentation, that this company is increasing its online sales, increasing its assets on online sales. So hopefully that helps it out. But net cash flow from operations have been pretty flat over time. Let me just take a look at metrics real quick. I just price to earnings ratio. Price to earnings ratio is getting higher and higher um over the past quarters. Like pretty sure these are investors betting money that this company is gonna be able to at least fight Amazon with now having these high online seller e-commerce type assets. So let's take a quick look. An income statement, we have that revenue increasing, that cost of revenue also increasing. We have that nice gross profit still increasing. We saw that net income is decreasing. I can't tell you why in the previous years, but this year had that quarter two big big time one time charge for selling assets in Brazil. Balance sheet, we have balance sheet. Our shareholder equity is it's decreasing, right? And that's something I don't like to see. Shareholder equity asset distribution, I'm not nothing's really scaring me from the asset distribution. It makes sense that both equipment planned properly and as well as inventory are a majority of their assets, right? Because that's pretty much what this company is. Liability distribution, one thing I do not like is total that total non-current debt seems to be increasing, and so is that payables, right? They don't seem to have been paying anything down, so they're really trying to, it seems they're trying to build up to grow, and that does seem a little scary for me. So at the moment, I personally, for my reasons, I think I would pass on Walmart, just because I don't think that e-commerce is going to be actually I'm not sure, would I pass or buy? So the numbers themselves are not that good, but they're not bad either, right? They're a little bit in. So right now, what's breaking me apart is, do I believe that these e-commerce business that they're adding and that they're increasing sales is gonna help them out in the long run, or is it gonna stall them back? And I mean, if they're able to sell more things online, obviously we should see um, a decrease in this total debt, right? Then they'll eventually start paying off this debt and increase revenue, and with e-commerce, hopefully have lower cost of revenue. But at the same time, is how much more are they gonna have to build, and how much more they're gonna have to buy, but at least make some form of dent in some other against some other companies like Amazon and e-commerce. That's, I think, a decision that one has to make themselves, and I'm not sure. If I was to think that this e-commerce was a good idea, I definitely would put a buy on it, but I'm not 100% sure. And for that reason, since I'm not sure, I'm gonna have to give it a pass. Like I said, I'm pretty sure you could be pretty good if you definitely believe this company is able to sell a lot of things online, and that e-commerce assets are gonna be a great thing for this company. This would have the company going pretty high. But for me at the moment, I don't feel that way, so I'm gonna have to give it a pass. Alright guys, I hope you guys enjoyed this episode. Like I mentioned, Lazy FA makes it so easy to look at all this information, makes these episodes go pretty fast. I'm curious, would you buy or pass on Walmart based on the information we saw in the past 2 episodes? Also, don't forget to subscribe to get updates on new episodes and other videos. Have a good night guys, and let me know what you guys think. Take care.